Consulin. Good to chat again, mate.
G'day, Bill. How are you?
Yeah, not too bad, not too bad. Look, a number of economists, where are you sitting with this? They're predicting a rate rise. Where do you see it sitting?
Look, it's going to be a close call, but I actually still think the Reserve Bank's going to keep rates on hold. The reason for that is that there's a few reasons for it. So obviously we got the May CPI indicator came in hotter than they expected at 4%. But the reason why it actually jumped was because we had a bigger fall in inflation a year ago. So inflation in May actually fell by 0.1%, which sort of seems counterintuitive. It's like inflation fell, but the inflation rose. How does that work?
Yeah,
it's because in May 2023 we had a 0.4% fall. So when you look at the last 12 months, May last year dropped out not minus 0.4, it was replaced by minus 0.1, and that meant that the annual rate rose. Now, the thing about it is, in June, so the Reserve Bank, before it has to make its next decision, will receive the Q2 CPI data. And going by the monthly indicator, we actually had a very, very high 0.7% reading in June last year, and that's going to drop out. And what that means is that the annual rate's going to fall again. So, yeah, a lot of this is noise around the monthly indicator. And the other thing to keep in mind is that the Reserve Bank has two mandates. So it's got obviously price stability, so it wants to keep inflation within its target, which we're obviously above that. The other one is full employment, which is a new mandate that was given to it. And in its minutes that it released yesterday, the Reserve Bank noted that it was a little bit concerned about the weakening of the labour market, which has weakened quicker than they expected. So based on that, that would then make the hurdle for a rate hike higher. So I think if the Reserve Bank's going to hike rates at its next meeting early next month, it needs to see two things. So first of all, it needs the quarterly CPI data to come in a lot stronger than it expected. And also it needs for the unemployment rate to fall. And I can't see those two things happening. I mean, it's possible. It certainly is possible, but I just think the balance of probabilities is that it will remain on hold for those two reasons.
Okay, so what are we expecting beyond that? Do you think it'll get back to tracking in the right direction?
Yeah. Well, I mean, certainly inflation is going to fall the next few months, regardless. So again, it's this noisy CPI indicator. So it jumps around on the monthly basis.
Yeah.
And the next 4 months of monthly CPI reads that'll fall out from last year are actually quite high. And what that means is the annual rate's going to fall, regardless. So I think based on that, and also I think the labour market's going to weaken quite materially in the next quarter or two, and that's going to stay the RBA's hand. That being said, I think starting December last year, I was tipping that we'd get rate cuts in the second half. I don't think that's likely now. I think it's probably going to be next year, early next year sometime. So I think they're just going to remain on hold for longer is the most likely thing. But then again, we'll just have to see how the data falls. I mean, between now and the next meeting from the RBA in early August, we get the all-important June labour market report. We also get the Q2 quarterly inflation, then we also get 2 retail sales prints. So there's a lot of data to come in between now and then. We'll just have to see which way the cards fall.
And what about the talk about the various state governments alongside the federal government making it harder for the RBA to keep the rates static with all the sugar hits we're getting, particularly up here ahead of the election?
Yeah, so there's two dynamics to that. So first of all is obviously the cost of living relief. Those things will mechanically lower inflation. It's really juking the stats. So they're going to lower electricity prices and rents directly. So this is both state and federal. But they're not obviously, I've said to you previously, it's a Band-Aid and it's not fixing the underlying problems of why we have those issues in the first place. The other side of the coin, which is a bit more important, is this massive increase in public works by state governments. And your government in particular, like Queensland, has lifted its capital expenditures by 102% between 2021-22 and 2024-25. That's according to CBA estimates. And what these massive big build projects are doing, so it's not just Queensland, it's Victoria, New South Wales, everywhere pretty much is doing it, is it's actually putting upward pressure on inflation because we've got a supply-constrained construction sector at the moment. We've got limited materials, limited labour. We've got Albo's 1.2 million housing target, which is never going to. We're obviously not going to meet that. There's not a snowflake's chance in hell.
Yeah.
But at the same time, we're trying to build houses at the same time as we're trying to build infrastructure, and that's just putting upward cost pressure on basically construction inflation.
Is it a bit? I feel like it's a bit the same with this renewables. I feel like a lot of the targets they've set there are completely unattainable targets as well. And is all that spending and cost allocation to that having the same impact?
Yeah, that's actually included in the capex numbers. So, and part of Queensland's big bill. The interesting thing about Queensland's is that 68% of it's actually outside of Brisbane, and only 3% of their massive infrastructure spending is actually on the Olympics. So it's on all these other things, infrastructure, the renewable energy, all this sorts of stuff, and it's just basically pumping demand in the economy, obviously. At the same time as it's worsening these capacity constraints we have in the construction sector, and that's inflationary, because it's going to bid up materials costs, it's going to bid up labour prices, all these sorts of things, and that all feeds inflation. But that being said, I do have some sympathy for the states because they're sort of caught between a rock and a hard place. So the federal government obviously pumping, unbelievable amounts of people into their jurisdiction. So, Queensland, you're getting all our southerners coming up, and as well as international migrants. People in New South Wales and Victoria getting displaced by international migrants. And the populations are growing very quickly, and the state governments have to build infrastructure in order to keep up with that population growth. So they're kind of caught between a rock and a hard place, where if they don't build it, you're going to get worsening congestion everywhere, and long run, you're going to have worsening productivity. But if they do build it, they're putting upward pressure on inflation in the short term. So I think the solution here, and I've said it to you previously, Bill, is the federal government needs to slash immigration dramatically to a level that's consistent with the nation's capacity to build housing infrastructure. Because at the moment, we're running it way higher than it should be, and that's leading to all these shortages in infrastructure and housing, which is one of the reasons why we have an inflation crisis. We've got obviously rents going through the roof because we can't build enough houses, and that's really the fundamental problem here. And the federal government's trying to get around all these problems by giving out cost of living relief and sugar hits. Yeah, it's not addressing the underlying problems of why we have this strong rental inflation, why we have soaring energy prices because of the whole East Coast gas debacle I've talked about previously. And we really need the federal government to fix those things rather than just trying to band-aid over all the problems by using our money to give out temporary subsidies.
There's a piece,
that's the fundamental problem.
Piece in the, I think it's in the Australian today by, you may know, Joe Brannigan, a director of Tulipwood Economics, talking about Queensland in particular with the level of borrowing and ahead of the election, and saying, look, it's been going well with all the coal mining royalties, but there's a lot of spending deficits, and the bottom line was Queensland faces over the next 2 decades a truly treacherous and rocky road in terms of managing the economy.
Yeah, and that's a fundamental problem for all the state governments, probably outside Western Australia, because it's this problem whereby the federal government is pumping in all these extra people that need services, they need housing, they need infrastructure, they need all these things that the states are required to provide. At the same time as the states don't receive the tax benefit from all that immigration. So I've said previously, 82% of the nation's tax take goes to the feds, primarily through income taxes and company taxes. The states and local governments only collect 18%, yet they're the ones who are shouldering the bill of the big migration program, and that's putting them into a structurally disastrous, budget position. And that's really the nub of the issue here. And it's not just Queensland. It's I'm a Victorian. It's way worse down here because we don't have any mineral wealth down here. And Victoria's verging on the closest thing you can get to bankruptcy as far as the state governments go. And it's largely brought about through 2 things. Obviously, negligence and poor fiscal management, but it's also because this whole thing about the federal government's pumping in all these extra people, and these people need services, they need infrastructure, they need all these sorts of things, which is just raising borrowing costs for state governments.
Yeah, Change texted in and said, the majority of cost of living pressures simply falls back on supply and demand. Why can't the government see it? Well, then that gets back to your inflation question again, I guess. Not inflation, your immigration. You got so many numbers creating that demand, we can't meet the supply.
That's right, yeah. I mean, the federal government just seems intent to just pump more demand into a supply-constrained economy. And, construction is just a classic. I mean, construction costs have gone up 40% since the start of the pandemic, and that's impacting, obviously, the cost of infrastructure, the cost of housing, all these sorts of things. And the worst thing you can do in a supply-constrained market is just continually ramp up demand to absurd levels. Now, according to the Australian Bureau of Statistics long-run population forecasts. I mean, Brisbane's population is meant to surge to over 4.5 million people in the next, 30 odd years, 30 to 40 years.
Mm-hmm.
I live in Melbourne. We're supposed to hit 9 million people by 2056. We were only 3.5 million at the turn of the century. These numbers are just absurd. And these are the official projections. And obviously, if you're going to grow the nation's population or capital cities' populations like science experiments, you're going to need a hell of a lot of infrastructure, you're going to need a hell of a lot of housing, and a hell of a lot of services. And this has to come from somewhere. And we just don't have the capacity to provide all these things to cope with such a massive population influx. And that's going to drive inflation, it's going to drive budget deficits, it's going to basically result in, ultimately worsening living standards. So this has all been foisted on us by the federal government, unfortunately.
All right, not a pleasant way to finish up, but appreciate you busting it all down for us as always. Thanks, Leith.
Yeah, cheers, Bill. Anytime.
Leith Van Onselen, the unconventional economist. Look, it's a pretty bleak picture, isn't it, when you point it that way? But it's all been caused by the federal government.